We're going to start with the Fed, the reaction to it. Franklin Templeton CEO Jenny Johnson is with us live here at Case. It's nice to see you. Welcome back.
Great to be here.
The market seemed to move up a little bit. You think that was on the notion of ending the runoff on the balance sheet? I mean, what did you make of the brief, at least, headlines that Steve was able to give us here?
You know, actually, let me step back for a second and say, all right, so we all know the Fed has two mandates, employment and inflation. So let's just look at those. The Dallas Fed last week came out with a really interesting study that I don't think has gotten enough coverage yet, where they basically said, hey, look, pre-COVID, the monthly equilibrium of jobs that had to be created was about 100,000 jobs, right? COVID, it went to 250,000 jobs. They actually said, we think that number is closer to 30,000 jobs a month to have equilibrium and unemployment. So everybody is seeing the lower jobs numbers and going, oh my gosh, this is a problem. They said, look, labor participation rate is down. Demographics have changed, and immigration has reduced. You had 3 million people immigrating. Now that's down to below 1 million people just 2 years ago. So one is there's less people that need a job to be at equilibrium. Well, how is it that that's okay for companies? Productivity has gone up 1%. For a decade, it was 1.5%. Now it's 2.5%. There are 156 million workers in the U.S. That's like 1.5 million less people needed to retain the same productivity. It actually feels like the labor market is okay, right? And you talk to restaurants and say, are you having an abundance of applications for people for jobs? No. And then the other thing that I think is lost a little bit on the inflation side, look, tariffs are inflationary. February next year, there's going to be $150 billion that are going to be handed consumers in tax refunds because of the SALT, as part of the big, beautiful bill. Think about how that stimulates the economy. So I look at it, and I think we think that the market is a little too bullish on their thoughts of 100 to 125 basis point cuts, in, say, the next year.
Nonetheless, though, it sounds to me like you think because of both financial and monetary, fiscal and monetary policy, that you're pretty bullish, it sounds to me.
I'm pretty bullish, yeah.
And do you think there's an AI bubble? Like, how are you thinking about that question? Because that seems to be hanging over this market now.
Sure. Look, bull markets are never linear, right? It's 2 steps forward, 1 step back, 5 steps forward, 2 steps back, right? Like, so we're in some of a little bit of a correction, but I look at it and say, look, I think the S&P is up 12.5% year to date, and the NASDAQ was up like 17%. It's been a great year. It's not surprising that you get times. Look, we're having the discussions on tariffs with China, right? This is all noise. It's going to affect you in the short run. On the other hand, I believe we are in early innings on what AI is doing. The picks and shovels, maybe that's somewhat more expensive, right? And the chips and the investments there. You still haven't even begun the investments that are going to need to happen in power, the grid, let alone how companies are actually getting advantages from AI. Honestly, most companies are just right now trying to figure out how to use it, and they're slightly improving things they already do. You're not getting it. It takes time for that to actually work through and actually impact companies' margins.
Is there a message in the run in gold? What's your view on that? Because it's been so astonishing, straight up and to the right. We'll show the chart as you answer that question, but what do you make of that?
Well, first of all, we haven't really talked about it. But if you talk about the bear case here, it's U.S. deficits, which are really a concern. You have to have a strong economy to grow to actually deal with some of these deficits. And I think that people worry a bit about inflation, and gold has always been sort of viewed as a hedge to inflation. So I think that actually, supports kind of the case that we still have a pretty robust economy here.
So we're visiting with you because you have made a larger play into the alts universe, and that's what this conference is all about. We're trying to educate our investing viewers on how they should be thinking about what the portfolio of the future looks like incorporating alternatives. How much do you think, and how much are you advising clients that they should have allocated to alts?
Yeah, so we have about $260 billion of our $1.6 trillion in alternatives, and our view is institutions obviously have been leveraging alternatives for a long time. They are illiquid. That is the message. Like, these are illiquid,
needs to be
right?
Yelled from the mountaintop, right?
Exactly. But you get a premium for that illiquidity, which is significant in a person's retirement plans, right, and their savings. So look, I think some individuals will get their alternatives exposure simply in an allocation, say in a mutual fund. Franklin's Equity Group is doing late-stage venture for over a decade because the old IPO kickers that we used to get have not happened in the same way, and so we started to do late-stage venture. So some of them will get that. Some will move into really these perpetual funds, which are interval funds, which allow 5% liquidity a quarter, and some that have more wealth will go into the drawdown type of category. So I think the good news is there's a lot of innovation happening that is going to allow the average person to be able to access alternatives. And honestly, I always say it's like akin to when my grandfather got into the mutual fund business. The average investor couldn't participate in the equity markets. Right now, the average investor can't participate in the private markets. And with the way that companies are waiting so long to go public and banks aren't lending in the same way, you need to be able to access. It's a massive opportunity.
I saw a pretty incredible stat. Only 3% on average, of advisor clients are allocated to alts.
That's right.
That shows how big what is already a mushrooming area of the investing universe can grow.
So I think that most folks would say, say in the next 5 years, that number could move up to 10 to 15%. And I think that's right. And I think a lot of that requires the innovation around the vehicles to ensure that it's delivered appropriately so that it's suitable for each client. And that's where we're big believers in the financial advisor. And as Case, as you know, it's built the pipeline to make it much easier for advisors to allocate to their clients. And so the financial advisor really knows what those clients' needs are to make sure that the vehicle is appropriate for each individual client.
I appreciate you spending time with us. We had some nice breaking news for you to react to as well.
Great
Jenny,
to be
it's good
here.
to see
Thanks,
you.
Scott.
Jenny Johnson of Franklin Templeton.